Hello, Wine and Dine listeners. This month, we are going to be featuring a winery called Hansen Vineyards. This is a family-run winery. And the really cool thing that we found out when we were visiting this winery is that the winemaker originally went to college in Ithaca, is from Oregon, but went to college in Ithaca, spent some time in Washington, D.C. He was super cool to talk to because he was more in the lawmaking side. So we had a little conversation about that, and then moved back to Oregon and his family farm with very, very deep roots in the area to, which I loved because they actually have that family farm and very deep roots. Of course, I loved that it was deep roots with Rooted Planting Group, but we had a chance to actually talk with them, with the winemaker when we were there. So much fun. If you want to follow him on Facebook, Instagram, and Twitter, it's Hansen Vineyards. So you can follow them there. But one thing that I discovered when I was there was that his great-grandfather's winemaker's great-grandfather was originally from Norway and moved to Oregon in 1896, purchased the farm that was across the road from the winery. They then took the property into a winery in 1930. So that's when it says very deep roots. That's what they mean. Well, let me tell you, we love their wine. Of course, they had a good Pinot Noir. That's what Oregon is known for. But today, what I'm going to talk about is their Gamay. The Gamay Noir is one of the different grapes that exists, and we loved it. It was unique. It was dry. It was mouthful, flavorful, really savored the wine. So if you enjoy something different, go try the Gamay Red that they have. It's $26 per bottle. Good price point. Of course, if you're going to have it shipped, there's additional costs associated with it. But we really enjoyed their Gamay. They do have a club that you can join if you're interested. Not trying to sell this company, of course, but I do really think that if you're looking for something different, there's no cost to join, which I absolutely love. If you get out to Oregon, there's complimentary wine tasting for you and your guests. You get 15% off the first 12 bottles each year. And then if you go beyond that, you get 25% off. You also have access to new and limited wines. And they do have some invitations that you can get invited to. One is out in July. Maybe it changes different each year. And then they do invite you to vertical tastings. Now, of course, we won't be able to be there, but we did talk to Jason, the winemaker, and ask if there's any way we could virtually do that. So we're trying to figure out how to do that. If we learn more, we'll certainly let you all know. One thing that I loved that Jason said to us is whether you're a wine connoisseur or a novice, I should say, he's very open to questions. And he really, truly embodied that. So, he said no questions are a dumb question. And we can usually get pretty deep in the weeds if you want, which is what we loved about our conversation. So we'd love for you to hop out onto their website, explore them. We're going to post a link in the Facebook page. And if you do happen to buy anything from them and he wants to know how you found out about us, just drop our name, Amy and Brent Irvine, or Wine and Dime Podcast. Thanks, everyone. We hope you enjoy the rest of the show. Every week, it's our goal to share financial information that helps you in both your life and financial vineyard. We hope it takes you from your roots to the journey of your vines and the influences in the air that help craft your delicious life. Like wine, life and finances have different palates that should be celebrated and not judged. Welcome to this edition of Wine and Dime with Amy Irvine and Ann Arceo. Welcome back, Ann.
Amy, thank you. Happy to be here.
We're talking all things retirement in the month of June, so we're excited to be having that conversation. And I say all things retirement, actually. We're talking mostly about saving for retirement, decumulation in retirement, and scary things that are happening in the market around retirement. So before we dig into that, for those of you that have been listening to the podcast throughout the month of June, I've been talking about a wine that is called The Element, which is made by our neighbors at Market Street, our neighbors at the office at Market Street, Quincy Exchange. The owner of Quincy Exchange actually makes this wine called The Element, and I've featured 3 of his other wines already this month. So I'm going to settle on the final one, which is a blend that he actually makes of 2 wines, Pinot Noir and Cab Franc, which, as you all know, is some of the wines that I often mention. But the wine name is Can't Stop, Won't Stop, which I thought was fun.
I love that.
Yeah. So they are actually right next door to us, literally, and in the Quincy Exchange, right at our Market Street office. So, I can walk out our front door, walk 25 feet, if that, into their front door. So the thing I like about that, as I've mentioned in a few of the other shows, is that they not only have their own wine, they actually have a lot of Finger Lakes wine. So, and when we get you out to the Finger Lakes to visit us, we will definitely take you right there. It's a one-stop shop in some sense of some of the wineries that you could taste, and then we can go from there in any which direction. But that has been I've enjoyed the tasting that I did with them, the element tasting that I did with them. I enjoyed their 4 features that they had the last time I was there. So if anybody's looking for a unique combination from the Finger Lakes area, both their Pinot Noir and their Cab Franc, I would highly suggest that. You can go out to their website and we'll have some notes, some stuff in the show notes. So if you want to try something from the other side of the country, and instead of like from Oregon, or because they're so well known for their Pinot Noirs, right? Mm-hmm. We can ship one out.
Nice.
Sometime. So our goal today, Anne and I wanted to chat with you just a little bit about what, there's a lot of scariness in the market. And by market, I'm specifically referring to the stock market. So we wanted to chat with you just a little bit today about what the down market and the impact on retirement savings can have, and also, the various stages of your life. So young savers versus those retiring soon versus those in retirement. Certainly if, some people, no matter what their age, have fears of what's going on in today's market. I always look at something like this and, think of it as a buying opportunity, but not everybody feels that way about it. And emotions are real, right? So how you feel about what's going on is a true feeling, and you should honor that feeling and think through what's bringing some fear to the table. Sometimes it's just not understanding business and economic cycles and how the market works as a general rule with them. Sometimes it's, the fact that you're making some decisions relatively soon and you feel like this might impact those decisions. When we run Monte Carlo simulations, retiring in an up market versus a down market, all of those sort of things. So we wanted to jam out a little bit about that particular topic. So Anne, let's get started with that. What are some of the thoughts that you have around all those different age groups that I mentioned and the down market and impact on retirement savings?
Yeah, so I think, starting with some of those younger savers, and we're talking, if you're 30 years from retirement, 20 years from retirement, it certainly feels scary to hear what's going on. You check your 401k or your retirement account and you see the balance going down, and that's discouraging. But just a reminder that, so much can happen in the next 30 years and the next 20 years, or, with the economy, with who's going to be in office, with, just so much can happen, so much can change. And we certainly want to encourage you to stay invested. Like Amy said, this is, these times can be a great buying opportunity. You're going to buy low and hopefully later on sell high. I mean, that's the goal with investing. So we see it as a time to keep saving, to save even more aggressively if you can, to write it out, to not, to try to just keep things into perspective that this is long-term money. And if it is stressing you out, maybe check the news a little less often, check your accounts a little less often, certainly put that solid strategy in place. And then you don't have to be checking it, every day, every week. That you have that strategy in place. It's long-term savings and you can feel good about that. I
always think, Anne, too, about, like I said earlier, I think about the market being on sale. And if you think about going into a grocery store, when they have those BOGOs, buy one, get one free type idea, or 20% off or half off or something, that's really what these economic cycles and stock market cycles do for us, right? They give us an opportunity to buy in at a little bit lower. But when people think of the rolling hills of a stock market, if they actually plotted those rolling hills, it's an incline, right? So each new peak that happens is higher than the last peak that happens. So it's actually an inclining, from peak to peak, it's an inclining schedule if you were to draw that line. So even if you, with the market going down and you being able to buy, that incline is actually sharper. So if you're saving in the 401k, like you mentioned, your dollar cost averaging, and some of those prices are you're getting more shares right now if you're continuing to save. This is actually, in my opinion, the time you would want to increase your savings into these plans if you can with your cash flow.
I agree. I agree with that. I think it's a great time, a great buying opportunity. And to, if you've got extra cash and you're looking, it's a good time to get into the market and invest more.
And then, when you have some of those folks that are getting, maybe they're not in retirement yet, but they're thinking about retirement. Do you have any thoughts on what they might want to be doing at this point in time? Not that it's any different, but just sort of some thoughts along those lines.
Yeah. I mean, I think it's certainly a crucial time for planning, for laying out cash flow, for looking at your overall investment allocation. And by that, we mean how much do you have in more aggressive investments like stocks? How much do you have in bonds, which, we consider to be less aggressive? And is it still appropriate? So, your investments when you're 20 years out from retirement are going to look different when you're just, a few years from retirement. You want to ideally start to be a little bit more conservative, start really laying out that plan of what your cash flow is going to look like and where you're going to be pulling the money from and, just really understanding the ideal, stocks to bonds balance and making sure that that looks appropriate. And then,
Oh, I was going to say, do you think sometimes that is the word appropriate? Do you think sometimes that people understand that, because you said it, laying out the cash flow. Mm-hmm. So if you have really good cash flow going into retirement, because of that, some people are more comfortable being more aggressive with their assets because they have really good cash flow. On the other hand, the question is, do you need to be more aggressive because you have really good cash flow? So I think the word appropriate needs to be defined. And that's the planning side that you were referring to.
Mm-hmm. Yeah. I mean, it's not people look for like online, well, when you're this age, you should have this allocation and these general, and pieces
recommendations.
Recommendations of advice. But, we really personalize that for you because there's a lot of elements that go into the right allocation for you. And like you've mentioned, I mean, we're working with some clients that have pensions and Social Security and their spending is pretty low and they're not really going to be pulling a lot out of their retirement savings. And if they're comfortable taking some additional risk, they certainly could do that. They don't need to take the risk because they don't need the higher return, but that comes down to their comfort level. So it's really, are you comfortable with risk? Are you going to be checking the market, often? Are you going to are you going to feel like you need to pull out when the market goes down? So it's looking at your comfort level, your time frame, your, individual cash flow and income and putting all those pieces together. And that's how we build the allocation that we feel, is going to work for you.
And also, I think one of the questions that we ask is, who is this money actually for? I mean, obviously it's for you as the person, right? But sometimes it's like, well, yeah, and I want to make sure that it's actually there for the kids too. Like, I know I'm probably not going to need all of this money. So maybe I'm investing not just for my life expectancy, but for the life expectancy of my children, which is very different when we're talking about, like you said, as the closer you get to retirement, we generally get more conservative. Well, if we're actually looking at your kids' retirement that we're actually managing for, it's a whole different allocation. So and as long as you feel comfortable with that ups and downs in the markets, I think that's the key to that conversation. Who are we actually investing that money for? Primarily you, yes, but secondarily, it might be somebody else in your life.
And I think when you were touching on the risk that you're comfortable with, it's over the last few years, we've seen these huge gains in the market and we've gone, to numerous clients and kind of warned them, hey, your portfolio is getting a little more aggressive. The stock side has grown. We should maybe reallocate things. And it's been hard for them to do that because they've seen the market grow. And then as soon as, that cycle happens and it starts to pull back and we see these drops, it is very emotional. And especially in retirement, when you're not adding to your savings anymore, it's very emotional. And I think trying to picture that in your mind and that feeling when you see that happen, are you really going to feel comfortable with this is important. because the last thing we want to do is just start pulling things out in a down market and locking in those losses.
And what about for those that are in retirement, if they are feeling, uncomfortable about what's going on? They've very likely been through these kinds of cycles before and have recovered, hopefully, from those cycles. I think I go back to the statement that you made, like, again, I'm not ignoring somebody's feelings, but maybe just sort of put it in the desk drawer for a little while and not, as long as your income needs are being met. But there's strategies, I think, that at least we put in place so that when these cycles, we know they're going to happen, we just don't know when. There's strategies that hopefully folks are aware of, or certainly we've tried to make people educated about the importance of asset allocation so that when they are in retirement and this happens, we aren't selling those assets that are down. And part of that is creating some cash cushion or conservative cushion in place. Do you want to talk just a little bit about that?
Yeah. So we keep talking a lot about cash flow and how important that is, but especially when you're in retirement. And, we like to go through with our clients and looking at, by cash flow, we're talking about your budget, your monthly budget. So what's coming in and what's going out? And is there going to be a shortfall for the year? Do you have enough in pension or Social Security to cover what's going to be coming out? Or are we going to be taking some from your account, and how much? And, what we like to do with clients, even if it's sometimes behind the scenes, is making sure that they have that cushion of at least 2 years. And so we have an emergency fund, but we also have this kind of cash, and it may be in brokered CDs. It may be in, short-term US Treasuries, and some of it may be in, a high yield savings account that we can pull from so that you can wait out some of these market ups and downs and some of this market volatility. And if things go down, you've got this cash flow laid out for a few years and you're not touching that money during the downtime. So I think that cash flow, especially in retirement, that cash flow planning is really crucial.
And it also can play into some tax planning strategies too. Sometimes we'll look at opportunities to get out of positions and actually do recognize those losses, and that benefit. Let's say a security is down about 10% or something like that, and we're able to recognize that loss, turn around and reinvest the money into something else that will hopefully come back and grow as well. But now we have that loss that we can actually recognize on your tax return. And hopefully the even if it's a similar but not enough similar to be considered a wash sale, then in that situation, tax loss harvesting, this is an opportunity to do that sort of thing in retirement too, to help offset some of the other income that you have and reduce your taxes. So losses are, I don't like to take them in retirement plans if I can avoid it, only because there's no tax advantage to that. But in brokerage portfolios, I look to these markets sometimes as opportunities in that way.
And I think one other, in what's happening right now with rising interest rates, that one upside for those people that are, we're telling them to have a little bit more of a cash cushion is that they can earn a little bit more on that cash. There's opportunities to look for brokered CDs and high yield savings accounts and things like that that are going to offer a little bit more in interest. So that's been one upside in this market.
And we are starting to see CDs actually come up in value, which, like you said, that hasn't happened in a while. So it's actually nice to see that kind of thing happening on the other side of the fence. And I know they just released last week or the week before. Well, from when we're recording, it'll be a few weeks longer for when people are listening. The savings bonds are up even more, right? They're now over 9% annualized. And so for folks that put money in those or are planning to put money into those are really high interest rates right now. A great place to stash some money. Those wouldn't necessarily be for short term, but maybe for a year, or two, or, when I say a year, the only reason I say that is because you are locked in for a year. And then after that, for the next 4 years, there are some penalties for taking money out of there. So if you've got some cash that for sure you're not going to need for a year, and if you understand that you'd have to pay a penalty if you needed it before then, that might be a place. or if it's someplace that you want some long-term money, who knows when interest rates are going to readjust, but usually we see a cycle about 18 months. 12 to 18 months is a typical cycle. So the Fed is pretty aggressively trying to raise interest rates to lower inflation. And if they're as effective as they think they're going to be by the time next year rolls around, we should be right-sized on where we're at with the growth and the inflation in our economy. When it comes to just kind of exploring this just a little bit further, when people are looking at, I want to focus just a little bit about people who are in retirement. If you're feeling or maybe soon to be in retirement, if you're feeling nervous, let's talk about going to, because I've had a few, not very many, but I've had a few people ask the question, should I go to cash? Or are there things that we should be watching that will, alert us to a possible pullback in the market or economic recession? And of course, there are leading indicators that exist. The stock market happens to be one of them. Mm-hmm. Right now, our economy is actually strong, and the stock market is looking down the road saying, I think the economy is going to slow down or we could go into recession. And that's why you're seeing the pullback that you're seeing. Rising gas rates are another, gas prices is another sort of leading indicator, because that hits so many aspects of our life. It's not just the gas tank, but it's ultimately our food, and almost everything else is affected by the price of gas. But going to cash isn't necessarily the answer either, because we never know when to get back in. Mm-hmm. So you could pull money out. By the time we know that we're heading in that direction, it's usually too late. And if we do it at that point in time, if we pull money out, when do we get back in? We never know when things are going to turn around. If you think about all of the recessions and all the all the stock market pullbacks you've ever lived through, especially if you're in retirement, you didn't know when we were at the bottom of the market. We didn't know when we were at the bottom of the market. Mm-hmm. So how do we know when to get back in? And there is great stuff out there that actually gives us some statistics on missing the best days of the market. I know there's a CNBC article, Anne, that you actually brought up that talked about if you miss the best days of the market, what you're giving up in return. Do you want to chat just a little bit about that?
Yeah. So, just kind of looking through it, it was giving some examples of the S&P 500. And, on October 13th, 2008, when we were still in the middle of things were looking pretty down at that time. And, but the return, was 11.6%. It went up by 11.6%. And then, looking at 2020 and the pandemic, and March 13th, 2020 went up, 9.3%. And so just by missing out on those days, you missed out on huge gains. And I mean, none of us, we don't have the crystal ball. We don't know when those times are going to happen. And I think, just pulling out and locking in such big losses, you're not going to know when to get back in. And especially looking at the examples of some of the gains in 2008, like overall, we weren't seeing, the economy, we weren't seeing the recovery yet. So, you certainly would have missed out on those big gains in your account had you pulled out on those days. So it's really hard to know. And we think that laying out a good plan, reminding yourself that you have the cash flow for the next couple of years, you don't need to touch this right now. You can you can ride through the cycle and be okay with your long-term money. So don't make, short-term decisions with your long-term money. Don't, just react. And we understand the fear. And I mean, every time feels a little bit different, because whatever causes the down cycle is a little bit different. The pandemic, it's what's happening now with the inflation and still kind of the effects of the pandemic and the supply chain and, what's happening overseas with Russia. And, every time feels different and scary. And this time might be different. But, we do go through these cycles. And I think it's just important to remind yourself that you have a plan in place and you're okay.
Yeah, I think just to sort of go back to because everybody seems to remember 2007 and 8 and 9, right? I mean, almost everybody remembers that time frame. And I always do. I can remember the date that the recovery started. It's crazy that that particular statistic sits in my mind because it was March 8th of 2009. And my husband said to me, what would you like for your birthday this year? And I said to him, I would love it if you could turn this market around. And then I went to work on March 9th and the market soared that day. I mean, just soared. And we can now look back at that and say that was the start of the recovery. If you look back in all the charts and historical, like when did the recovery start? It was March 9th of 2009. Now I remember that because I asked for that for a birthday present. So I'm like, okay, Brian, you have some magic powers, honey. Like, put this to work. But we didn't know that. We did not know that because remember, the economy did not fully recover until 2011. So the stock market started turning around in 2009, but the economy did not actually have recovery until 2011. So that's where I think there's some disconnect sometimes of understanding, like right now we have a really strong economy. Why is the stock market doing so badly? Because the stock market is a forward-looking indicator. Mm. So by the time we actually go into a true slowdown or even recession, probably the stock market will already start to have turned around. So we can't wait for that. And we just don't know when it's going to happen. So I just like to bring that up because that's a point that I think a lot of people just don't understand that. And I just like to share that so that everybody understands that there is those periods where we just don't know what's going to happen. Although long term, going back to the goal setting, we've been rerunning, our projections on retirement plans for our clients. And when you run those projections, especially in our system, there's the Monte Carlo projections. Well, Monte Carlo takes into consideration market corrections, right? Mm-hmm. So far, the projections I've been running still show success rates that are high because our previous probabilities did take into consideration these kinds of markets. Mm-hmm. Now, are the asset adjustments there? Sure. The assets are starting at a different point because they're down to a certain extent, but the percentages seem to still be successful. But I would encourage people, if you're feeling uneasy with what's going on, that's something that happens. And I know June is a big month for us to meet with our clients and rerun those projections as well, just to see where they're at. I think that's what we do need to be focused on, like you said, Anne. Let's not focus on the market. Let's focus on the goals and see if the goals are still achievable.
Mm-hmm. Yeah, I think planning is so important, especially right now.
Yeah. Any other tips or suggestions or ideas that you would share with the listeners this month around this particular topic?
I was just thinking, when we were talking about when you are in retirement and you're planning out this cash flow for the next couple of years, one strategy we've been using is the brokered CDs, is laddering them. So you could, if you know that you're going to have something happen in 3 months or 6 months, you can use different time frames on those to earn, the higher interest, but to make the cash flow work for you. And we've been working a lot with clients to build out that strategy. And I think, when interest rates were so low, it wasn't as effective of a strategy. Mm-hmm. But I think with interest rates going up and seeing that come up a little bit with these CDs, that's, a renewed strategy that would revisit with clients that are in retirement.
Mm-hmm. So more to come on that topic, right? As we meet with clients throughout the summer and take advantage of some of those opportunities. Like we're saying, we're starting sort of that 3 or 6, 9, 12 month sort of strategy. But then as interest rates go up, we may push those out just a little bit if we can lock in some 4 or 5 or, percent. I don't know that that's what interest rates are going to go to, but if it does, then that's kind of a nice fixed rate of return for some of that fixed income money. And hopefully we were able to get some of those. Hopefully we're able to see them again.
Yeah. And I think I'm sorry, Amy. I was just going to say, I think that has to just be when you're in retirement, planning out, even younger clients planning out a future home purchase or knowing that they're going to need this cash, in the next couple of years. You don't necessarily want to take a lot of risk with it, but that can be strategies for younger clients who need some cash reserves, but also, want to earn a little bit on it.
Yeah, especially if they don't need it right away, right? I mean, that's a great strategy to ladder it. If they have multiple goals and they're short term within like 2 to 3 years, I would consider those relatively short term in nature. That's the perfect solution for that money because, it can earn high yield checking and savings accounts right now still are not at that level. So if we're able to get a fixed rate of return, it's an ideal situation. So yeah, good point that you brought up. Well, we hope everybody has enjoyed this episode of Wine and Dime, and we'd love to hear from you if there's topics that you'd like us to be chatting about and digging into a little bit more. We'll certainly place some things in the show notes that we mentioned. We hope everybody that does share this with their friends and family that might find it useful. And of course, we always ask that you go out on iTunes and rate us so that more people can find us. And we hope that some of the things that we shared with you today do bring you some peace and allow you to go refocus some time and joy with your family and hopefully not worry about this as much. But we understand that this is very emotional and we do not want to discount the fear that you may be feeling. We also want you to understand that a lot of things that we look at incorporate these market corrections. So hopefully that does take some of the fear out of the way that you're feeling. We hope you have a great week, everybody.
And that will about do it for today's episode of Wine and Dime. You can contact Amy through the website, www.rootedpg.com, or amy@rootedpg.com. You can also follow us on Facebook and Instagram @rootedpg for the latest news. And if you have any questions, comments, or topics you would like to hear about, feel free to let us know. And don't forget to rate and subscribe the show wherever you get your podcasts. And again, thank you for listening, and be sure to tune in next time.